Understanding banking and inside money. In our last video, we covered outside money. Now let's cover the money we all use, inside money. Inside money is money that's created inside the private sector. This exists primarily as bank deposits and includes things like credit cards, debit cards, or even your Venmo or your PayPal payments. The best way to understand inside money is to understand that the government has essentially outsourced money creation to private competitive banks who compete for loans to create deposits. Deposits are the things we all use to transact in the modern economy, but those deposits come from the loan creation process. A common fallacy in macroeconomics is the idea that banks need money to make more money. But this isn't really true. Banks don't lend the existing money that they have. Banks have to meet certain government regulatory requirements, but they've essentially been licensed the ability to create new dollars through the loan creation process. Let's use a simple example to better understand this concept. In this example, we have Fund Bank, and they have $1,000 of outstanding loans, which are matched by $1,000 of existing deposits. They also have a $100 reserve requirement, and they've raised $100 of equity. If Jane were to come along to Fund Bank to get a $100 loan, this would result in 4 new accounting entries. A $100 deposit asset for Jane, a $100 loan liability for Jane, a $100 loan asset for Fund Bank, and a $100 deposit liability for Fund Bank. Now you might be wondering at this point, where the heck did the money come from? The reality of a modern monetary system is that it's something that human beings conjured up from nothing. It's all essentially records of account that we keep and create from thin air. This doesn't mean this money isn't supported by anything, though. In fact, it's supported by the resources we mobilize and create in the process of creating all these loans and different various financial assets. Although banks create most of the money in the modern economy in the form of inside money, the government has a backdoor way of creating inside money through the creation of outside money. When the government spends more than they tax, they have to finance this by creating bonds, which are new assets created from thin air to finance this new spending. When the government prints these bonds from nothing, the central bank can come in a program that's been commonly called as quantitative easing and swap those bonds into deposits, which essentially forces the banking system to convert some of the government bonds into inside money in the form of deposits. Don't worry, I'll cover all the fun details of quantitative easing in a future video. But for now, those are the 2 primary ways that inside money and deposits dominate the modern monetary system. Alright, I went over 3 minutes, but hey, look on the bright side. I didn't even make you look at my face once in this video.